Gold on another tear today. Metal stocks big movers on the TSX. To discuss an outlook for Canadian equities in 2026, we've got Darren Dansereau, Chief Executive Officer at QV Investors. Thanks for joining us today.
Thanks for having me today.
Is gold overbought?
Well, I think as some people would say that, but I think what we've seen in the markets these days are individuals looking at gold as a place to put money because they're not sure what's going to happen with the US dollar. So I would say if you look at some of the shorter term technicals, it looks overbought, but I think you're seeing multiple people in the markets stating that gold can go higher. One thing here at QV we don't try to do is predict where commodity prices are going because it's quite difficult. But I think just as we're seeing, and you talked about recently or earlier on the show, talking about what's happening at the Fed, potentially you could get people concerned about the interest rates going down. US dollar would then go down and people looking for an alternative, and that could be gold.
You mentioned that you don't look ahead to how much a stock could gain, for example, but because of the uncertainty at the start of the year that we've seen and heard about already, do you think that could sustain a run for 2026 for gold?
I think it could sustain a run. I think the one thing that somebody could do is look at gold as an alternative to some of the other asset classes out there. I think the big risk though is the big move that it has had. I think when somebody's developing a portfolio, looking at a variety of different asset classes, so rather than selecting gold as a main component, gold may be a piece of it, but looking at some of the other alternative stocks out there, and we're seeing some attractive opportunities in Canada, especially in small cap, but also seeing it in global markets ex the US, just because we have seen a big valuation change upwards in the US.
So gold has given the TSX a lift in 2025. How would you describe the broader market right now?
I would say the broader market, when we take a look at the returns, so in Canada last year, we had a 31% return. About 11% of that, by some calculations I've seen, has been a result of valuation expansion. So not earnings per share growth, but value expansion. So that's a pretty significant component. So last year, what we saw is the TSX catch up in terms of valuation to the US, not to the same level. It's still trading below. But I think what we have to do is just be more careful as investors as to where we select, what sectors we select investments. So those that are not trading at all-time high valuations. When we take a look at some sectors, and an example I'll use is grocery stores, we see Loblaws trading at 27 times price earnings at a very high level compared to where it's historically traded. So there are some areas that we need to be cautious about. So there's opportunities. One that we would talk about today is the transportation. We're seeing some weakness there, very high quality businesses. That we think people could take opportunity of. And I'm speaking about Transforce, CN, CP Rail as examples.
Okay. We have the PM heading to China. As you know, electric vehicles will likely be up for discussion. Do you expect much movement there? Ontario, we know, has a base of manufacturing for a lot of autos. They don't want to see a tariff lifted on Chinese EVs. So do you expect much out of those conversations?
Well, I think the main thing that we should think about is we are seeing a PM of Canada go there after a pretty long hiatus. So I think the important thing is we have the PM going, Mr. Carney, going to China to start those discussions. And I think the biggest component is, what exactly is going to be said and what's going to be agreed upon, we're not sure at this point. But I think we are interested in some sort of deal that allows some of our farm products to be exported. And there may be some concessions that need to be made, whether it's on EVs or whether it's other parts of our market. I think a negotiation would be beneficial to Canada, and I would assume that's what Mr. Carney is looking at.
All right, let's get to one or two of your stock picks. National Bank is one you like. Will financials, you think, do well this year, and why this one?
So I think the biggest thing that we've talked about here at QV is just valuations have been moving up, as I mentioned before, in the whole market, but especially so in financials. What we do have, though, is an advantage in a company like National Bank. It has lots of capital. We've seen it actually use that capital in buying some Laurentian Bank portfolios. That put some of that capital to work. What we've also seen is them make the acquisition of Canadian Western Bank that has allowed them to use some of their capital, but also provide revenue synergies and cost synergies. So right now, the CWB acquisition has allowed them to gain a significant amount of synergies. And in their latest result, they stated that they expect 200 to 250 million of revenue synergies. That was the first time they came out with that number. So for a company like National Bank, we do still think there's opportunity going forward.
Okay. You like WSP Global as well, which is an engineering company. I guess they also do the actual building or construction. Tell me a little bit more about why WSP is a pick for you.
So for WSP and engineering companies in general, what we like about them is we are seeing a lot of projects. We've talked about over the last year, all the number of projects that are being fast-tracked. I think they will have an advantage there in Canada, but also in other countries. They're very cash flow generative. Not a lot of capital is required because this is a people business. And what we've also seen is the organic growth at WSP has been mid-single digits. And then we also have acquisitions. So recently they announced an acquisition of TRC companies, $3.3 billion US acquisition, which would also give them growth. And so over the last little while, we've actually seen the organic growth of mid-single digits, as I said, but then also growth on the inorganic with their acquisition that has led to meaningful organic growth going forward. And what we've seen over the last 5 years, the company is kind of moving back and forth, some organic, some inorganic, but overall we've seen very strong earnings growth. And we've also seen with the number of people they're adding with these acquisitions, the cost per employee is coming down. So the margins are actually increasing. So their operating margins are sitting around 14, 15%, which are very high levels and continue to move up slowly, which we'd like to see.
Okay, I see 12 buys here when I look at the WSP Global rating. So 12 buys and 1 hold. So a lot of people in that same boat with you. Darren, thanks for joining us. Appreciate your time.